Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better so as to let you retire with comfort and on your own terms. While most know the name Grant Hackett and remember his race for gold back at the 2000 Olympics in Sydney, many, though, would not know he is now the CEO of Generation Life Investment Bonds. For us in the finance profession, investment bonds are one of those best kept secrets which really everyone should know about. So anyone thinking of saving for a long-term project, such as for their children's education or a deposit for a new property, investment bonds with their unique tax benefits make saving for any long-term project that much easier. So I'm thankful to have Grant here today to talk about investment bonds, why he sees so much benefit in them, and we'll also touch on his sporting background, especially how being coached in any aspect of life, not just sporting, makes reaching goals so much easier. Well, welcome, Grant, to the show.
Thanks very much for having me, Mark. Appreciate it.
Well, I'm really actually excited, and apart from obviously you're on the show, but we're talking about investment bonds or insurance bonds, and I've been recommending them for over 30 years, and I do think they're one of the industry's best kept investment secrets. So from your point of view, would you like to give a high level overview of what they actually are?
Yeah, sure. No worries. It's very, very simple, really. The best reference that I have for an investment bond and what it actually is first and foremost, just think of it like a legal structure. So, when you look at a company, it's got a legal structure, it's got certain rules that you play within. If you look at your superannuation, again, it's another legal structure. If you look at a trust, again, it's another legal structure with certain rules and benefits. And that's exactly what an investment bond is with it. Because a lot of people hear the word bond and they think fixed interest product, and it's not that at all. It's just another structure to house some of your investments through. So first and foremost, that's what it is. The big differential and what it's similar to is superannuation. It's a lot more flexible than super, a lot more liquid than super. But where it aligns is the fact that it's an after-tax paying structure. So you don't have to do any of the administration, any of the compliance, anything else like that that would normally be quite costly and time consuming. When it comes to an investment bond, you put your money into the investment bond, determine what assets or asset allocation that you actually want to have, and then whatever returns you receive are always on an after-tax basis. And now the maximum tax rate is 30% of an investment bond. So naturally, if you pay tax above that, there's a natural tax arbitrage in there. But a lot of our funds, the effective tax rates, but by the time we add back the franking credits, or we utilize some of the tax losses where we can offset against income because we work on revenue account, we can actually bring our effective tax rates down to well under 20%. So there can be quite a significant tax arbitrage in there, but there's a lot of other ancillary benefits, particularly around estate planning, creditor protection, that are quite unique to investment bonds. So yeah, it's just another sleeve for investment. You're using your personal name, you're using your super. Now a lot of people are using their investment bond.
Yeah, and you've explained that well. And one of the things I like when I talk to clients about it, because normally no one's ever heard of them, is that it's just very similar to super. So if you see your super, you see that as a fund, you have all your managed funds choices, whether it's balanced growth, conservative, and it's exactly what this is, but this is accessible. It's still very tax effective. And one of the things people say, well, I've got these investments, I've got to pay tax every year on the interest. Well, this is already, the tax has been paid by the company. And so it's less tax work, so which is definitely a bonus.
Exactly. And what we see, just a couple of the core uses of an investment bond. The tax arbitrage is obviously there. And if people are going to start earning money on their investments and they're already on a high marginal tax rate or getting very close to a high marginal tax rate, obviously you don't want to spill over with your investment income then, making you start to pay 47 cents on the dollar. So it's a great way to be able to house investments in a much lower tax rate environment and not put yourself up into the next sort of tax bracket and, obviously giving that money to the ATO where you don't need to. The other aspect for some of the core use of the bond that's been really powerful at the moment is not the tax arbitrage, but it's around estate planning because of binding nominations. So a lot of people, particularly people who have quite, a large amount of wealth, have been using it, to beneficiaries as grandchildren because they can control how and when the funds are distributed. And none of these have ever been overturned. So if you've set up an investment bond to a beneficiary, you're 100% reassured that those funds are going to go there, and they don't go through your estate, they don't go through probate. An example of that is if someone was to receive a $300,000 bond, for argument's sake, that and they were the beneficiary of that particular $300,000 of the bond owner, what would happen is we would get a copy of the death certificate. We would then take that money out, and it would be passed on to the beneficiary probably within 10 working days. So it's not this whole sort of saga of going through the estates and dealing with litigation potentially, if it's going to be quite an acrimonious process, which for a lot of families that does take place. So and the other aspect that people don't appreciate about the investment bond structure is the fact that it's both tax-free, whether you're a dependent or a non-dependent. So, you receive a lot of reassurance in terms of transferring wealth when you're doing it through an investment bond in comparison to a lot of other structures. So that's been a really, big core use and a large amount of our inflows over the last 18 months in particular.
And one of the things, a practical example off the back of the estate planning benefits is for grandchildren, your school fees. And I did read some stats somewhere that said more than 50% of school fees are actually paid by the grandparents, not the parents. So, as a grandparent, as part of their estate, knowing that their grandchildren's school fees are going to be sorted because they've got this bond that can never, it's not part of the estate, can't be part of any potential litigation, and is protected, is a terrific benefit.
Absolutely, you're carving it out for a use for future generations and to be able to manage those costs. And actually, I'm based here down in Melbourne, and I spoke to a couple of board members. This is going back a couple of years ago to one of the major private schools down here. And they actually said that for their school, 62% of the school fees are paid by grandparents.
Wow.
So it's amazing how much of a use an investment bond can be for the grandparents, and to be able to carve it out for their grandchildren for that future cost. Because obviously a lot of people send their kids to private schools, in particular when it comes to secondary school, not necessarily primary. The other aspect to that is when it comes to grandparents, obviously they've got their kids, they've had children. But they're sometimes unsure about their children's marriages or relationships, and sometimes they can already be divorced. But if there's children that have come out of that partnership, the grandparents still want to look after the kids, but they don't necessarily want to pass money through the estate or down to the next generation because they're worried that those funds might get misused. So the investment bond is a really reassuring way and secure way of being able to transfer that asset down to that generation and control how those funds are transferred. So a lot of grandparents will set up what we call a future event facility that we have here at Generation Life, where they can control how and when those funds are distributed. So, if they pass away and a child might only be 12 years of age, but there's a $200,000 investment bond that's going to them, you don't want that whole capital amount going to them because you might trust the person that's actually going to look after those funds on their behalf. So you can say they can have access to those funds at age 21, and they can have access to, say, 15 or 20% of the capital amount per year for 10 years. And then after that point in time, we can then release those restrictions and they can fully access the capital. So from a financial advisor's point of view in particular, it's amazing what they can do with their clients strategically to be able to help that transfer of wealth. And obviously with baby boomers, really considering their estate planning purposes and requirements at the moment, and, the blended family situations and all the unique situations and permutations that we find in the family tree, they can really cater for a very complex problem in a very simple way.
And it's great, some of these examples you're using, and there's a couple more, especially for downsizers we're seeing in Sydney and Melbourne, that I've definitely have seen some of my clients and other advisors or coaches use. But actually, if we take one step back, why don't people know about these? I've known about it for 30 odd years as an advisor, but even advisors seem to sort of say, well there's managed funds, there's other things. Investment bonds haven't been popular for a while. So
yeah, it's funny. It hasn't been one of those mainstream products, and I think the reality when it came to superannuation and investment bonds was really in that inflection point in 1992. So to give the kind of timeline of investment bonds, they've been around much longer than super, and so has the tax rules and the other rules around estate planning that I've discussed so far throughout the podcast. But what's quite interesting, it used to be the quarter the size of superannuation, and they were very much mainstream. And this is going back to the 70s and 80s. And then 92, the changes to super, and super just became too attractive. Now it's 15%. We had that year, I think, in 2007, where Peter Costello said you could put $1 million in tax-free, and there was all this attractiveness around super. There was no caps inside superannuation, so people were just piling money into this 15% tax environment. And why wouldn't you? And you could have the choice of any investment that you wanted to, where investment bonds got left behind. There was no innovation in the space. A lot of the providers back then were life companies, because you can only be a life company to be able to distribute this structure out to investors and through financial advisors. So really, there was no product innovation in there. That was seen as pretty expensive at the time. There was bundled commissions back in the 80s. All of that has changed now. Now you can have any asset class and multiple options within each. They're very, very cost effective. We have a tiered pricing structure where you average around 35, 40 basis points to access the investment bond and the underlying investments. There's a significant tax arbitrage in there. There's a lot of flexibility with the structure again. So we've really been able to bring it back to life. And this is, ironically, the changes back to superannuation on the 1st of July 2017, of course, where all the caps came in, whether it was the total balance cap or whether it was the concession.
1.7 million caps now.
Yeah. So people are like, well, where do I put this money now that I was traditionally putting in super? Or financial advisors around their strategies would normally advise clients to put that excess funds or that surplus funds into their superannuation. So we've seen a real revival in this space, but we're having to re-educate people on two fronts. One is, breaking some of the common fallacies that probably some of the older financial advisors that were aware around investment bonds going back to the 80s, early 90s, and actually re-educating them on what they look like today. And then there's a whole market of financial advisors and investors that really may have heard of them briefly, but have no real education or awareness around what they do or the strategies that you can actually deploy through the investment bonds. So to give a bit of an idea of the growth that we've received in our business since 2017, if I go back to the amount of inflows we did in a year then, it was 131 million. We did it over the course of 12 months.
Right.
We did that in 10 weeks this year.
Oh,
so
wow.
the popularity of the bonds is starting to come back, and people are really starting to see the benefits.
And I can see, and what I just mentioned before about downsizing, that was one I really clearly see. The majority of my clients are that 50 to 60-year-old age bracket, and a lot of them were saying, well, okay, we're approaching retirement, whatever that may look like, and it may not be in Sydney or Melbourne anymore, so I'm going to downsize somewhere else. And a perfect example is if you had
It'd be much cheaper too, Mark, if you're downsizing and moving out of one of those two cities.
Oh, absolutely. And if it was the example that a lot of people would downsize and may have 500,000 or $1 million left over, well, they're only limited per person 300,000 into their, or 330,000 now into their super. Yep. They might still have another couple of 100,000, and what do they do with that? And you don't want to just leave it in cash, which is earning nothing. Yep. And this has just been where I just see these investment bonds as a perfect way of, for your transition retirement to, you might even not wanting to be touching your super just yet. You want to be able to have an income stream. And I know bonds are very flexible on the income. You can just sort of set it yourself a monthly salary to be drawn down. It's tax effective. And it just allows your super to keep growing in the background until you actually need it, maybe post 65.
Absolutely. We actually see a lot of people that might even be in their 40s that are on high marginal tax rates, know that they're going to reach the max super balance, but haven't necessarily got there yet. But start using an investment bond as complementary to their super, and also attach a savings plan to it for a lot of their surplus income. Because they want to be able to have, to your point, Mark, that optionality around transition to retirement in their 50s, where they don't necessarily want to work 5 days a week. They don't want to necessarily be paying tax or accessing their super when they have the opportunity to do so down the line. So this is a great way to tax effectively to supplement income, not access your super, and just do that transition to retirement exactly the way you want to in that tax effective way. And like I said, this is fully liquid. There's a lot of tax benefits after 10 years, but there's a lot of tax benefits also inside 10 years. So strategically, they support a lot of people's behaviors in terms of what they want to achieve, in those last couple of decades, going into retirement, or, when they're going to eventually access their super. And the reality with superannuation too, that I think we're seeing in a lot of the conversations that we're having at Generation Life is there's a little bit of almost distrust, because the rules change so often. So people, as much as they want to put their money in that really low tax environment, and it's a great, vehicle for obviously saving and, preparing for retirement, and it's got all its protection around it. People are saying, well, there's so many changes, the caps that came in through a Liberal government, I think that was Kelly O'Dwyer back in the 2014 Financial Services Inquiry that, sort of ended up doing that and implementing those changes. And it's like, well, there's been, I think, over 200 changes in the last 15 or 20 years in super, and about 10 major ones. So you go, it's the shifting sands of super, I think, that make people go, well, it's nice to have some alternatives out there that can complement the strategy that I'm trying to achieve for me going into retirement or my personal set of circumstances. So, that is, sort of feeding through a lot of the conversations that we're seeing at the moment as well.
Yeah, and I just think with people looking at retirement, and there's lots of other options for investment bonds, but just people looking at retirement and they are worried about their super and the rules changing all the time. But I think one thing that I definitely always tell my clients is that at the end of the day, the government can't afford people to be on Social Security. That's eventually must stop for new entrants. The age is already creeping up to 67 from what it used to be. Yep. And so they will always encourage people to live off their superannuation or other tax effective investments. So yes, I think governments can't help themselves but tinker with superannuation, but at the end of the day, the grey army
it's a $3 trillion, pot of gold for them. So if they just change the rules a little bit, and particularly all the money and, the expenditure that's happened throughout COVID, obviously, we're not going to be into surplus for a very, very long time. So, if you look at this big pot of money, you go, okay, we set this up for people to retire, not as a tax arbitrage for the wealthy. And if you even look at, I guess, the proposal that Shorten and Bowen had when we were coming into the last federal election a few years ago, they were going to change everything from trust being taxed at the first dollar, the highest marginal tax rate. There was a lot of debate and discussion around the franking inside superannuation. So that was probably the big one that was front and center. There was also the changes around negative gearing they were talking about. So there was so many things that were being discussed, and we were really lucky sitting here as an investment bond provider that there was no changes. And in fact, we've received no changes in our space for 20 years. So, we don't have that crystal ball saying there won't be any changes, legislative changes down the line. But for now, on the empirical evidence, it's pretty clear that we're a structure that's relatively stable and very safe.
Yeah, and apart from the tax effectiveness of it, there's how that works and all that. Won't get into this, but there definitely are the tax benefits of these bonds. But historically, and as I said, I've been recommending these for over 30 years, the one negative that really isn't there today was that there was very limited investment choice, and the fees were high, so the performance wasn't there in effect. So that's not the case now, though, is it? The choice you have in investment is nearly as good as any super fund.
Absolutely. So, just on our investment menu, we've got 61 options in there. We've got every asset class covered. We've got multiple options within each. You can, go into a diversified fund, or you can do a sort of core satellite approach. You can go in and, basically construct a portfolio any which way you like, depending on your view. And you can change that around, and you can actually change it around. And there's no CGT that's triggered when you're on our investment menu, which is a really big benefit of an investment bond that not too many people appreciate as well. So, in this day and age, you've got all of that investment choice, and you've got it cost effectively too. And you've got obviously the tax effective overlay sitting with all of that. And the other aspect that people don't really appreciate about investment bonds is the fact that under Section 1162D of the Bankruptcy Act is that they're creditor protected as well. So there's so many nuances and features within a bond, and so many different strategies as a financial advisor that you can actually deploy to your clients depending on their set of circumstances, that it's quite remarkable that there's not, a larger uptake than what we're seeing at the moment. But like any sort of investment structure or underlying product, it takes time to educate the market, for them to build confidence and to understand exactly where it fits in their overall strategy. And that's what Generation Life is here for. We've got a whole technical team, we've got a massive distribution team that continually work with financial advisors and their practices, and even direct to clients. Like I'm meeting a client here on Monday just to talk about a large deal since the sale of a business. And they've got a heap of cash sitting in the bank, and they can't put any more money in superannuation. So this is the logical path to go down. So yeah, it's an exciting time for the business. It's one of the big reasons I joined, because I saw this opportunity out in the marketplace, and I thought, great challenge to be able to go out there and educate and work with the industry. But what a great opportunity at the same time.
Yeah, because I was curious about that, because you've been in this industry for a long time and you would have had a choice of roles. Yes, Gen Life, when you popped up there, I was a bit surprised. So obviously, yeah, there's a huge opportunity.
Yeah, so yeah, to the point, I saw the opportunity in the market, and I thought, geez, this would be a really great challenge. And it's my personality to gravitate towards things that are kind of uncut gems that I can see, and hopefully they are gems. They're, not cubic zirconia. So, and so far, it's been an amazing journey over the past 4 or 5 years that I've been a part of this organisation. But another big aspect for me is the people that I work with. So we've got a really bunch of smart people here, and our chairman at Generation Development Group, which is our parent company, is a guy by the name of Rob Coombe. He's very well known in financial services, was the CEO of BT, was currently the executive chairman of Colonial First State. So, was the chairman of MLC at one stage as well. So he's got an amazing CV. But I love working with Rob just because of his underlying ethics, the way he approaches business. I've learned so much off him, but also his performance approach towards business.
Right.
And, it reminds me a lot of my coach when I was actually in sport, when I was in swimming. It's kind of like, okay, we'll set the bar here, but we can actually reach to here, and always thinking ahead, and always almost eternally dissatisfied with the result. Like, what more can we do? And I think for me, that whole sort of mindset towards growth and trying to achieve more and challenge ourselves more, and I find I just naturally, gravitate towards that, and we just get along very, very well. And I've just learned so much off him because of his experience and the drive that he has. So, that combined with the opportunity of Generation Life and the investment bonds certainly attracted me to it, and definitely don't have any regrets.
Yeah, and I can understand, and I can definitely understand those reasons. And one of the things you did actually just mention there, and you was about coaching, when you're being coached, and also financial advisors. And we have had this discussion before, where the good thing about Gen Life is it is available to anyone. So you don't need to go through a financial advisor. But speaking from the financial advisor point of view, or financial coach, it's one of those things that in life, whether sport, the top sports person, and definitely you can speak to this, still has a coach. So why wouldn't anyone, when it comes to their own finances, have someone who can help them coach and help them with knowing about things like these Generation Life bonds? Because day to day, you're just busy with life. It's hard to get things and being held accountable even to get to reach any goal.
Oh, I couldn't agree with that statement more. We're such big believers in financial advice here at Generation Life, purely for that reason. Whatever your investment returns or the structuring or whatever you need, just on the basis, the simple hygiene factor of discipline and being focused on your finances to make sure that you've got a few goals in place and you've actually got a plan in place to reach those goals. You need someone on your shoulder looking over it to make sure that you're doing everything that you said you would do. It's funny, it's this whole environment that we're in at the moment. A lot of people working from home, and you need to have that flexible structure running a business these days. But we're all better as humans when we're accountable. I know even at the very top of my sport, if I had to do a session on my own versus my coach was there, I would always get more if my coach was there. Yeah. And I was hugely motivated and got pretty good results at what I did over those years of swimming. But if I had a coach there supporting me, whether it was a strength and conditioning coach in the gym, whether it was in the pool who was my main coach, whether it was, someone teaching me about movement of the body and what I could do in terms of my flexibility and strength and other things that, all contributed to that singular performance, then why wouldn't you need that across every sort of major category in your life? Whether it's your work, whether you're running a business and you need a mentor, whether it's your own finances. I mean, paying off your own home, how much do you need in super? What other assets should you be looking at? What's the difference between deductible debt and non-deductible debt? Should I set up a trust structure for my family or shouldn't I? What's the cost of running all these things? How much surplus income do I actually have? Paying tax. I mean, we don't learn any of these things at school, ironically enough. So when we get into our adult life, we actually need a financial coach there supporting and helping and driving and motivating us almost all the time to do things and say, hey, maybe with that bonus that you've just received, don't head down to Louis Vuitton and buy the latest handbag. Maybe this is a better use of your money. Or maybe it is time for a reward. I know even when I was swimming, I'd set up 3 different bank accounts. One was for mortgages and bills, one was for investments, and then I would have a discretionary account where I could actually go out there and buy the things that I wanted to buy. So, having disciplines in place when it comes to anything in life is important, but particularly when it comes to money. So I don't understand why anybody wouldn't be getting advice or coaching or mentoring around this sort of stuff, because it's just such a critical element of your life.
Yeah, and definitely understatement, you did pretty well in swimming. Yeah, no, I absolutely think you did pretty well in swimming.
Okay.
Yeah, you did okay. But exactly what you just talked about, the cash, different cash accounts, and we actually help our clients, because if you don't get your cash flow right, it's in any small business, you're not going to have a business. But yet most people don't look at their cash flow, and they're living basically paycheck to paycheck, and don't have any savings. So, and we saw
it creates an anxiety, right? Like,
yeah, absolutely.
When you feel like that, it's like, God, and a lot of people earn really good money. They could be on $200,000, $300,000, $400,000 a year, but still going, why don't I have anything? Why haven't I been able to save money? It's amazing, if you don't actually have a structure or a plan in place, how, the almost, as we used to call it in swimming, trimming the fat. You have so much fat in your life. It's not to do with a physical thing, by the way. You've got to watch these things in this day and age. But it's almost like, where are the areas where you're just sloppy, where you haven't got the discipline in place? And, we used to call trimming the fat was around the technique, when you just do loose things. And it's the same with your money. You could be doing loose things that you just don't know that it's been spent over here or spent over there, or you're not maximizing, your structures and strategies that you should have in place to, lower your overall tax position, so that you have surplus income or cash to be able to invest. So it's all these little things that really start to add up in any field that actually then eventually make a material difference.
And if COVID really taught us anything, it was how many people were unprepared and didn't have at least, say, 1 or 3 months savings. We know 3.5 million people dipped into their superannuation to draw down the 10,000, and many did it twice. And the second thing we really saw was how well Afterpay did during COVID. So that's a lot of debt that people are also introducing into their lives. So anything that we can do, and I'm totally with you, education at school it just has to be. It has to be a priority.
Exactly. And you've got to know what you're getting yourself into as well. So, it's amazing the amount of people that you might talk to that have scratched themselves just to buy a new house in this environment when interest rates are at record lows. But we all know that it's not going to happen forever. So, but if you had some good coaching around that, you could actually model out, okay, this is how it's going to look for you. And it's funny when you actually put things on a spreadsheet, and I love a good spreadsheet, so I'm always putting stuff on there. And even for me, who's, I've done an MBA and I've, done plenty of study in finance and worked in finance for a long time. Even when I'm thinking about committing to an investment or to an asset, then you put it out in a spreadsheet and you match your cash flows with it. What's my asset liability position? And then you go, wow, I shouldn't be probably spending that much. That actually was a bit of a shock. And a lot of people don't do that. They sort of go, I'll do something and then I'll figure it out later, which is never a good plan, because it's not a plan at all. So yeah, I'm just such a believer that when it comes to this sort of stuff, that you need support there, you need guidance, and you almost got to remove that level of ignorance as well, and actually, get the support that you need.
Yeah. And one other thing you mentioned that I wouldn't mind touching on, because I found it a great use for your bonds or investment bonds, was having that discretionary or savings account, I should say, that extra bank account. And a lot of people, I say, well, if you start a regular savings program, you need to get your money working as hard as possible in that account. And whether that's an ING Direct or some cash managed account that's giving you a better interest rate. And I know there's things like Raise and Spaceship have come on the market, but Gen Life are great for that, or investment bonds, because you've talked about, yes, if you have a couple of $100,000, you have a lump sum, but actually as a savings program, they're very easy to use as well.
Yeah, I think it's almost around a third of every new investor that we have attaches savings plan to their investment bond. Right. So, each money you direct debit that money out of their account, and obviously, it goes into the bond, into the investment. So, you're getting the double whammy of great investment returns, but also a tax arbitrage for a lot of our investors. So the interesting thing about that, I find it's just another layer of discipline, right? Like, it's cash that you can't touch because, that's committed to that, like your mortgage. So I think for people that are going to invest in an investment bond, it's a really smart idea to always attach that savings plan, because it's just a natural way to put a layer of discipline in place. And it's quite phenomenal when we do modeling for some of even our bigger clients, where they say, oh, okay, I want to know the difference between not having a savings plan versus having a savings plan. And it's not huge amounts of money necessarily attached to the savings plan, but the difference it can make over that sort of 5, 10 or 15-year period is significant. So, and it's a very compelling proposition once you see those sort of numbers.
And when we're saying locked away, one of the things that I really like about it is it's semi-locked away. It's not like you've got a tap and go card so you can just draw your money out at an ATM. You've got to give it like 5-7 days notice. So it's always there. If there's an emergency, you've got your access to those funds at all times. Yep. But you just have to think about it. Yeah, 5 or 7 days, and that can help in that discipline.
It is, because you feel like you've committed to something as well. So I think it's natural human behavior. Once something is there, I don't want to touch it, because it's kind of like I had an intent, a purpose for that particular set of funds. And particularly if you're, saving for private school fees for kids that you might have had, then, you go, okay, we've gone through a bit of a contraction, or someone in the family might have lost a job, or something's taken place, but you go, let's not necessarily go there for liquidity. Let's go over here. And we very much saw that through COVID, because when you build up, the time frame that you've held an investment bond for, the more you maximize those tax benefits. And what was really interesting, as a business, we had to do our financial modeling to see how much COVID would impact us. And I did all the worst case, base case, best case scenario, and none of that worked. What actually happened is redemptions in our business through COVID went down from March 2020, and our inflows went up. So we actually had our all-time record in Q4 of FY20, which we just found phenomenal. So not even our best case scenario was anywhere what we predicted. And it really proved to us that people have real intent for the money that they when they invest through an investment bond, whether it's for estate planning, whether it's a tax arbitrage, whether they've held it for a few years and they want to retain all those tax benefits that they've been able to build up along the way. So that was really comforting to see. But again, to your point, Mark, it's creating that level of discipline where, if things get a little bit tough, they try and do everything not to touch the asset, even though they do have full liquidity and they can put in a redemption that day. And as soon as the fund manager gives us the money, we'll pass it back to the individual.
Yeah, I think especially for when we're talking about savings plans and for children's savings programs for, say, private schools or for whatever, whether it's high school or university, just some of the numbers that I've done for clients. And as I said, it's $200, $300, $400 a month.
Yep.
But really, if that's over a 10, 12, 15-year period, especially, once they're born in the high schools 12 years from now, it's nearly paid for half their school fees. It's incredible how using, the magic of compounding interest, even though for a lot of people that's a very boring subject, but for us in this industry, just seeing how that in reality works, that if you imagine your school fees, 50% of it's just being paid by the interest, compounding interest, that's a great result.
Wasn't it Einstein that he said it was like the eighth wonder of the world was compound interest, or something along those lines? I'm not 100% sure on that, but it is. It's phenomenal when we do comparisons for clients and financial advisors who want to do it for this exact purpose, where we'll look at the modelling. If you start off with a small bond of 30 or 40,000 with a certain amount going in the savings plan per month, and how that can contribute tax effectively to the school fees along the way. And then you do the modelling against pay as you go. So, as a high marginal tax paying individual who's funding their kids to go to private schools, the difference in terms of what one cost is versus the other is huge, is absolutely huge. So, it's just a disciplined way. It's a less stressful way because, you've got a plan around it, and it's a much more cost effective way to be able to fund what is super expensive. I mean, if you look at just the cost of private schools in Sydney or Melbourne, once they're getting to kind of year 7 or 8 these days, the costs are well over $30,000 just in tuition fees a year. If you look at buying, people don't just do it for private school fees. They might do it for another future cost, such as a deposit on a first house.
Yes.
Look at Sydney or Melbourne markets. I mean, take Sydney. I mean, what would it be now for a 20% deposit plus stamp duty? Probably $350,000, $360,000
up there.
So you come out of university, you get a job that's paying you $60,000 or $70,000 a year, pay tax and living expenses. That's going to be sucked up because the cost of living in Australia is so expensive. like it could take you 15 plus years just to save your deposit. So a lot of the time, parents or grandparents are helping, young people out that have come out of university that are working now that want to get into their first home, because it's almost becoming an unattainable asset for some parts of, the demographics that are out there that have, highly educated, very successful people, but it's just so expensive to get into property.
And that's it. It's just that deposit. And a lot of, well, that's where, my niche, the sandwich generation, where people in their 50s and 60s are wanting, how do they help their adult children, millennials, get that financial head start? And usually if we can help as a deposit or, even guarantor, and there's a whole section just on that, how you can do that as a parent. And this is a perfect way, even just to try and get that going. I've taken up a lot of your time, Grant, so I appreciate that, but I wouldn't let you go. And I should also say about the actual Gen Life bonds, I will provide links to how to get that, because there's a stack of really good information and resources on the website, so people can look at that, because it's not necessary to actually invest through a financial advisor, even though I am biased. You can do that direct. But just from, you were talking about coaching in your previous life with the swimming, and I've loved team sports because of the camaraderie and you can motivate each other. And I think I could have a bit of a bow to sort of how that works with financial advising, and you're on your own and having a coach. But what helped motivate you to be successful? And why did you even choose an individual sport compared to a team sport?
It's really funny, I guess. First and foremost, the one thing that I've always noted that's a big difference between a team sport and individual sport is the full accountability. So I like that. Like you could have the best day, looking sort of down to the MCG right now. So an AFL team or a cricket team, you could have the best day in your career, but lose. Or you could have the worst day in your career and win. So that's the big difference, where I know that result is 100% on me, unless of course I'm a part of a relay team. So, I'm just contributing as best as I can to get the best result possible. But it's really funny. The execution of swimming is really individual. No one can help you once you're standing on those blocks on your own, but everything else around that is very much team orientated. I traveled with a team of, 40 other athletes with 36 support staff around that were coaches, managers, masseurs, physiotherapists, all that sort of stuff. So nutritionists. So the whole time you're, training in a squad, you're working with all of the different departments, whether it's across strength and conditioning to nutrition to your actual swimming coach. So it was very much team orientated the whole time. And the nice thing about our environment, it was both male and female too. And we could have a Liesl Jones at the Sydney Olympics who was 15, or the 50-meter sprinter who was as old as 30 in the team. So we've got this really diverse bunch. So it's a great environment to be amongst, because you're sort of socializing with so many different sort of people and different age groups. So you do learn a lot through all of that. And also you've got, the relays in there, which are quite significant and a big part of not just that particular team, but when we do well in relays, we motivate actually the rest of the team around their performances. So as much as people see that, a few minutes of execution that they think it's really individual, there's this whole team dynamic that is just filtering through the whole time. And I think that was probably a little bit more on the surface when, we saw Tokyo recently, those Olympics. Just you could see when we were performing well, how that would feed into particularly the girls' side of the team, or the ladies' side of the team, how well they actually all performed, because it built confidence that they could all do well at that level. And so it's quite an amazing dynamic. But what I do love is that accountability. I know if I'm standing up on the blocks, if I've done the work, put the training in, my mind is ready to go that particular day and I'm ready to execute, that performance will fully fall on me. But in saying that, I still love a team. But what I like about a team is just what I can contribute to it, because I love, seeing other people lift and get the best out of themselves. And I think that's why I was captain of the team, or I'm a CEO in business now, is because I actually genuinely get a big buzz or a big kick out of seeing people step up and get more out of themselves than even what they thought they could. For me, back in, I think it was 2005, I got the captaincy of the team. And my coach was really worried at the time because he thought it might actually distract me from my performances. Right. It was really funny. I actually performed twice as well, got World Swimmer of the Year, and also got Swimmer of the Year. So I got a lot of support back from the athletes who I was giving support to. So for me, my performance is motivated at working with people and seeing people do well. So and I think that's why I've kind of ended up in these roles.
And especially from what you're just saying there, the mentorship that you've been able to provide in those roles previously in the past. And I know when I speak to young advisors, and I always say, whether it's someone old or just someone that helps keep you account, you just need to be able to talk to someone, bounce ideas off, and to, warts and all, tell them the way it is. So, and people are very happy to help.
Yeah, most people want to help. Most people want to see other people do well, and I get a real kick out of it. So I'm happy to do that. And the funniest thing is, I'm not sure how you find it, Mark, but I really find once I start talking about a piece of subject matter that's important, whether it's anything from your finances or to something that's going on in life, often enough you start to come to the answers a lot yourself. Just bouncing off people. So it's just so important to have someone that is a trusted advisor, that is a mentor to you, that is a coach, that you can actually bounce these things off, because bottling it up inside and getting too much in your head manifests, I think, the wrong sort of thoughts. But once you start laying things out on the table with someone else, getting a little bit of guidance around it, I think you produce much, much better outcomes.
I totally agree. One final question. It's one we ask, and you've actually given some great pieces of advice already, but it is the final bite that we like to have. And what's the best piece of advice you've heard over the years?
Oh, good question. Actually, the thing I'm going to say, the first thing that popped into my head when you said that, because that's normally right, was my dad always said to me, be number one, but train like you're number two. So, and because I always think complacency is the destroyer of anything great. So whenever you're on top, you can normally get complacent. As they say, after your biggest successes, your biggest failures can come, and vice versa. So I've always held on to that statement, and I always approach things like that. So if we're doing really well, think of it as you're not doing so well, and you got to step up, or you're on the cusp of not doing so well. So I always think, be number one, but train like you're number two.
That's an excellent piece of advice. Well, Grant, it's been just wonderful having a chat with you, and you gave myself, and I'm sure a lot of the listeners, a lot of joy in your swimming, and I appreciate what you're doing with Gen Life, and just thank you for being on the show.
No worries. Thanks for having me on it, Mark. Much appreciated.
Thank you for listening to today's episode. If you'd like to know more about Grant or Gen Life bonds, visit genlife.com.au, genlife.com.au. Also, feel free to email me on admin@themoneysandwich.com or visit our website, themoneysandwich.com, if you have any questions or want to learn more. Enjoyed this episode and want to hear more of A Bite from the Money Sandwich? Make sure you subscribe on your platform of choice so you automatically receive each episode as soon as it's released. As with every podcast, this information is not advice, as not personalized to your own situation, and past performance is never guaranteed for the future. What we're trying to do here is provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.